Good morning, everyone. Welcome to our Conversations with the Fed event on understanding the FOMC's Summary of Economic Projections. My name is Carmiana Matson. I am the Assistant Vice President of Regional Outreach and Public Programs at the Federal Reserve Bank of Minneapolis. And I'm joined today by the Minneapolis Fed's Vice President of Research, Ben Malin. Now, before I turn it over to Ben, I have a few housekeeping items. This presentation is part of our long-running Conversations with the Fed discussion series, and I'll place a link in the chat to our previous presentations if you'd like to catch up on any of those. You may also be familiar with our recurring series on regional economic conditions. We appreciate you joining us for our virtual offerings, and we'll keep you apprised of future events in our series via email. We will also be emailing slides of Ben's presentation and a copy of this video link to all registered attendees next week. Ben will be entertaining questions during his presentation. So if you do have a question while he is talking, please type it in the chat box on Zoom, and then I will pose those questions to him verbally as he goes. And finally, we would love to get your feedback on this session. So at the end of this presentation, if you could take just a moment to fill out the brief 3-question survey that's going to pop up in your Zoom window when you exit the webinar. And with that, I will turn it over to Ben.
Great. Thank you, Carmi, and good morning to everyone. Today, I'm going to be talking about the FOMC's Summary of Economic Projections. Now, in an hour, my goal is that you should be able to answer the following questions. What is the Summary of Economic Projections? What does the Fed mean when we talk about forward guidance? And in what sense does the SEP, which sometimes I'll use as the abbreviation for Summary of Economic Projections, provide forward guidance? Finally, what is the dot plot? Which is often sometimes something you might see in the Wall Street Journal or some paper here in 3 weeks. What are they referring to when they use those words in connection to monetary policy? Let me start with a quote by former Fed Chair and Nobel Prize laureate Ben Bernanke when talking about the power of communication. He says, "I think monetary policy is 98% talk and 2% action." Okay, what does he mean by that? The action he's referring to in this context was the action of changing the short-term interest rate, the federal funds rate target that the FOMC, or Federal Open Market Committee, the policy-making body of the Federal Reserve, that's the monetary policy tool or interest rate that they set. That's the action. But he's referring to actually moving that rate actually is not the most powerful part of monetary policy. Actually, the most powerful part of monetary policy is the communication. So not just the current rate, but how we communicate about the entire path of rates going forward and how that affects how people act. So how does the FOMC talk if talk is 98% of the power of monetary policy? Well, there's different forms of communication. There's qualitative guidance. Here I list a few examples. So think about when the Federal Open Market Committee has a meeting, like they will in 3 weeks. There's at the end of the meeting, they make a decision on policy and they put out a post-meeting policy statement, 4 or 5, maybe 6 paragraphs explaining their objectives, their outlook on the economy, how that outlook affects the policy decision they decided to take. Chair Powell, at the end of the meeting as well, 30 minutes after the policy statement comes out, he holds a press conference. He takes questions from reporters and explains some more of the thinking of policymakers behind the decision they made. And then there's also speeches and testimonies by FOMC participants, not just on, around the meeting. In fact, there's a blackout period. They don't speak so much right around the meeting, but in the days following, in the weeks in between, leading up to the next meeting. So we've seen many interviews, for example, even this week, when various Federal Reserve policymakers have been out describing their views on the economy. But all those things are really kind of qualitative in form. There's also a form of quantitative guidance, and that's a summary of economic projections. So let me describe exactly what that is. So 4 times a year, it's in the FOMC meets 8 times a year, so twice a quarter. But in the second meeting of each quarter, so in March, June, September, and December, the SEP is put out, And what happens for that is each of the 19 FOMC participants, so there's 12 regional bank presidents and 7 governors at the board. Actually, right now, there's only 6 governors at the board, so there'd be 18 participants. They submit projections, or you might say forecasts, for a handful of variables. That would be GDP growth, so a measure of economic activity, the unemployment rate, so a measure of labor market, measures of prices, headline and core inflation. By core, we refer to inflation that that doesn't include food or energy prices, and then the federal funds rate. And they put out these projections for these 5 variables under the assumption of their expectations for how these variables will move over time under an appropriate stance of monetary policy. So the federal funds rate is under their control. These projections, done independently by each of the FOMC participants, are then summarized and they're distributed to the public. So on the day of the next FOMC meeting, 3 weeks from today, the SEP will come out and there will actually be a 17-page or so document showing various tables and figures summarizing the information that's in the projections. Let me show you, I think, the primary takeaway from that, or just obviously it's 17 pages. I'm going to show you one small table just to give you a sense of what's in that document and what people who follow the Federal Reserve, the FOMC, are looking at. So this table here shows the median projection from the most recent version of the SEP, that which was issued back in March of this year. And as you see, there are the 5 variables that I just described on the previous slide listed in the column on the left. And for each of those variables, each FOMC participant is asked, let's take the first row, real GDP growth. What do you think under appropriate monetary policy will be the growth rate of GDP as of the end of this year, the end of next year, 2024, and the end of it, 2025, and then also in the longer run, where the longer run could be thought of as the time at which current shocks hitting the economy have died out. So maybe 5 to 6 years from now. And so what this table is showing here for real GDP growth is, the median. So across all, I guess it was 18 participants in March, what was the middle projection for this year? So slower economic growth, little under 0.5% for the year. And then, growth picking up next year and into 2025 being more at its long run level of about 1.8% at an annual rate. For the unemployment rate, we're currently have an unemployment rate of 3.4%. So the committee, the median member sees inflation or unemployment increasing by about a percentage point by the end of the year, which would be consistent with this economy growing at a slower rate than its potential. They see inflation coming down. So inflation is currently 4.2% for headline inflation, 4.6% for core PCE. They see each of those coming down by about a percentage point when measured on a 12-month basis by the end of this year, and then coming down further toward our target of 2% in the next couple of years. And finally, the federal funds rate, the median projection at the end of the year is at 5.1%, which is actually the current rate after when this projection came out in March. That was not the rate. There was a 25 basis point increase in March, and then a 25 basis point increase in May at the beginning of this month, which brought us to 5.1%. But as of March, the median member of the committee thought 5.1% at the end of the year would be the appropriate stance of policy. Now, there's a distribution around that, and we'll talk about that more in a few slides. Now, they also see the federal funds rate kind of gradually declining towards what they would think is a long run measure of it, 2.5%, over the next couple of years as inflation comes down. So let me move on from there. So that's the summary of economic projections. As I said when I started the presentation, this is a tool of quantitative guidance for the FOMC. So what are some things, what's some information that the SEP provides? I'm going to touch on 4 bits of information that one can learn from looking at the SEP, maybe looking at multiple SEPs, looking at how it changes over time, and so on. I'm going to try to illustrate each of these concepts by giving an example of where you could learn this type of information. So let me start with the first. One of the things that the Summary of Economic Projections provides is indirect information about how the FOMC reacts to economic developments and information that they're processing. So when I think about how the FOMC reacts, I'm going to use the shorthand, their reaction function. How does policy react to or change with incoming data or a change in the economic outlook? So let me give an example of this. From September of 2021, okay, so 20 months ago, to March of this year, which was the last time that we had an SEP, what are some of the shocks that hit the economy? Well, first of all, there were lingering effects of COVID worldwide. So obviously COVID itself was not a shock, but the fact that even after vaccines had been developed and rolled out, that there continued to be flare-ups, supply chains continued to be snarled. I say worldwide because in some countries like China, even last year, there were big shutdowns, even when the US had moved past shutdowns. So there were kind of, maybe going into 2022 or at the end of 2021, people thought, well, we have the vaccines rolled out, COVID will be in the rearview mirror soon. It turned out that it wasn't, that throughout 2022, we had continued effects of COVID slowing things down. There's also a war in Europe that started early last year, which had not been foreseen and was a huge shock in terms of its effect on economic activity and worldwide inflation. And I'll show you some of that, where that shows up in subsequent slides. There was persistent supply disruptions, and that's related to the previous 2 points about COVID, the pandemic and the war, so that supply chains continued to be snarled and gummed up, and various problems arose in various places. Also consistent with, stemming from the war, we received higher energy and food prices as the supply of key commodities was limited. And then finally, I put down banking sector turmoil, obviously, which occurred in March of this year with the failure of SVB, of Signature Bank, and so on, and some things there. So all of those things, I would say, in some ways, are shocks that couldn't be seen as of September 2021, but that occurred, and then the Federal Reserve is going to have to react to that. So what do we see from the SEP about how the Federal Reserve is reacting? So here I'm going to show, once again, a median projection for our 5 variables. It's the median projection not at different points in time, but for a median projection for these variables and what they would be at the end of this year, the end of 2023. But the median projection made at different times. So this first column here would have been the median projection for the end of 2023 that was made in September of 2021. So you see real GDP growth, 2.5%. As we had shocks, okay, so let's going from the left to the right here, we have how this projection for 2023 growth changed over time. So what was it in March of 2022, in September of last year, and now March of this year? And this is in reaction to shocks that we had. So you see from March of 2022 to September of 2022, as the war started and the war persisted, a big revision downwards in how much economic growth was expected. Also, along with that, we'll go to the 3rd and 4th rows, which are headline and core inflation, an upward revision to the expectations for how much inflation the U.S. economy would experience in 2023. So up from 2.2% to 3.3% over the course of 18 months was the change in expectations about headline inflation, a little bigger even for core inflation. And now here's the part that's the reaction function. So remember, GDP growth, unemployment rate, inflation, those are variables determined in the whole economy. They're outside of the control of the Federal Reserve, although our policy does influence them. How does the Fed respond to, in this case, it was developments that caused expectations for slowing growth and for higher inflation? Well, the Fed's expectations for the interest rate that they would be setting at the end of this year increased. And they actually increased kind of strongly over time, but especially early last year and through the middle of last year, and then a little bit more in the last 6 months through March of this year. And so that's saying, you know, how is the Fed reacting to higher inflation? Well, they're expecting to, the FOMC is expecting to raise its interest rates more. Now, there's also a little endogeneity here, right? So the Federal Reserve also understands that as it's raising interest rates, that's slowing, something that's going to contribute to slower economic growth, to maybe a higher unemployment rate, and tamp down a little bit on inflation. So I spoke as it is, it's just a one-way reaction, but there's kind of an interaction, a dynamic understanding the policymakers are bringing to how do developments affect what is appropriate policy? How does policy change? How will the economy respond to that? So these higher interest rates themselves are kind of adding on, maybe bringing down growth a little bit, bringing down inflation a little bit. But this is the altogether what it looks like. This would be the median projection, how it changed over time. So you can see from looking at successive SEPs, how policymakers are responding to incoming data. Okay, the second bit of information that the SEP provides is information about the future path of policy rates, which we call forward guidance. And so let me illustrate that by, again, walking you through how data changed from September 2021 till the present. So I'm going to show you a series here of 4 or 5 charts. They're all the same setup. We'll just see the data evolve. But they show on the x-axis, right, data from, we're going to show time series or data over time from 2019 till up through the present and into the future, some expectations for the future. Okay, and what I'm showing here to start with is data up through September of 2021. This blue line, this navy line that kind of moves in a step feature is our federal funds rate target. So this is the Fed's monetary policy tool, a short run rate, so overnight rate at which banks can borrow from and lend to one another. Okay, so this is the monetary policy the Fed sets. The orange line and then the red line are 2 market interest rates. So the orange line is the rate on 2-year treasury bills. So the rate at which the government can borrow from the public on bonds, on securities that have a 2-year maturity. And so we see up through September 2021, it was basically very, very close to 0 and bounces around a little bit, a few basis points here and there from day to day, but it's around 0. The red line is the rate, the average rate on a 30-year fixed rate mortgage. And so as, one of the reasons we look at this is because even though the Federal Reserve, its policy rate is the overnight rate, no people, no firms, no households in the market borrow, well, other than banks from one another, but no kind of end consumers or businesses who are investing borrow at the overnight rate. When you get a new mortgage to buy a home, you're getting a mortgage rate that's maybe a 30-year, maybe a 15-year rate. When corporations borrow, they're borrowing in the corporate bond market or they're taking a loan from bank, typically with a maturity, say 5 to 7 years, something longer like that. So even though the Federal Reserve controls the short-term rate, when we think about the effect of interest rates on the economy, we think about how it affects the cost of spending, and that's going to be a long-term rate, so a longer mortgage rate, longer corporate bond rate. And now there's a connection between short-term rates and longer rates. the expectation of short rates over, say, the next 2 years should affect the 2-year Treasury rate. The expectation of short rates over the next 30 years, over the next 5, 7, whatever, 10 years, is going to affect some of these longer rates that matter for households and firms. And so we see the 30-year mortgage rate, right, in 2019 through the fall of 2021, coming down from 4.5% to, hovering around very low levels historically, 3% through most 2021. Okay, so that's where we were at the end of, or at September 2021. This blue dash line, okay, is as of September 2021, if you looked at the median projection, so the median again of the middle of all these policymakers, what they thought the federal funds rate would be at the end of 2023, which was at that time very low, and the end of I'm sorry, this is the end of 22. So that's why I'm putting that dot. It shows up right by the 2023 click, but it's the end of 2022. And at the end of 2023, around at 1%, the end of 2024, 1.9%. Okay, so let's go forward now. What I'm going to do is I'm going to move us forward 6 months from September 2021 to March 2022. And for those of you who watch closely the economy, you may remember some context around this time. What was happening in 2021? So in 2021, the economy was opening back up. We had started to actually see some measures of high inflation coming in, but there was talk about, well, inflation may be transitory in the summer of 2021. So in the spring of 2021, inflation had come in pretty fast. In the summer, it was kind of moving down. Okay, unemployment was still much above kind of what we would consider an equilibrium, a natural level. So unemployment was still elevated in that summer. But in the fall of 2021, inflation started to pick up. And the narrative that it might be transitory, we're relearning that no, COVID, the effects are lingering longer, effects of pandemic are happening. So the Federal Reserve, started to say, we're going to change policy. But we didn't actually raise rates until 6 months from there in March of 2022. So let me go forward 6 months. And what we see there in this blue line down here, remember this is the federal funds rate, this navy blue line. In March of 2022, we increased, or the FOMC increased rates for the first time, 25 basis point increase. Now, even though the short rate increased for the first time and it was a really small increase, look what's happening with longer rates. So the 2-year Treasury from September 2021 till March went up 2 percentage points. It's kind of increasing continually over this period. The mortgage rate goes up more than a percentage point from 3 to 4%. So that's even though short-term rates haven't moved, longer-term rates are already moving up. Why? This goes back to Bernanke's opening quote. The power of monetary policy is not only action, that's a very small part, it's talk. It's communication. What's one of the ways the FOMC was talking? Well, as of in March, and actually in December as well, but I'm not showing that. But in March of 2022, it put out its SEP, and this yellow dash line is the median path for the federal funds rate over the next 2 years. And you can see that even though, right, the actual policy rate only increased 25 basis points here, the expected path of monetary policy going forward shifted up quite a bit. In fact, the 2-year Treasury, think about this orange line, 2-year Treasury is kind of being an average of this gold line over the next 2 years. And now you can start seeing how the Federal Reserve's talk or the Federal Reserve's communication or its forward guidance from the SEP, but also in other forms, could move up the expectations for short-term rates, even though the short-term rate itself, the federal funds rate, hadn't moved up throughout this period, these 6 months. And once expectations of short-term rates move up, the orange line, longer rates move up as well. And that's going to start affecting household decisions as the ability to borrow or the rate at which they can borrow becomes higher. Let's go forward again here, 6 months forward, and we see continued tightening of the federal funds rate, continued upward movement in both Treasury rates and then the mortgage rate going now from 4% almost up to 7%. a shift up in of policymakers' expectations of how high of rates are going to be needed to bring inflation under control. And so that happens throughout last year. Turning into this year, the last 6 months, I put at the top of the slide, tightening almost completed, a question mark. It's not completely obvious, but as of March of this year, we saw really this kind of flattening of a few more increases in the federal funds rate over the preceding 6 months, but the federal funds rate being in the high 4%, and the expectation, like I said earlier, for the end of this year, end of 2023, being at 5.1%. Now you'll see some movements here, mortgage rates going sideways and treasury securities going sideways and down a little bit with the turmoil in the banking sector. Let me go forward even to where we are today a little bit more. We continue to see that sideways movement with in longer term rates, the red and the orange, with one more increase in the short term rate. So, there's a question that the FOMC will have at its next meeting about both where to raise rates, or if to raise rates, or what to do with rates in June. And there will be also a question, we'll get a new summary of economic projections for June. So not only will we have a new a point here for the federal funds rate, but we'll also have a new path going forward. And I think that path is actually going to be one of the most interesting things that comes out of the meeting. Where are policymakers at? How are they thinking about economic activity, hiring, inflation, and so on that has occurred, and what that means for monetary policy going forward?
And Ben, if I could just jump in here with a question from the chat box.
Sure.
We have a listener who's saying, we've often said that monetary policy works on a long lag. And perhaps what you're implying here is that the lag isn't as long as we have thought when we're seeing those rates starting to raise just based on forward guidance. Could you talk a little bit about that?
Yeah, that's a great question. And this is an active area of, I think, both debate amongst policymakers, amongst academic economists, amongst watchers of how monetary policy affects the economy. It is a debate. So when people talk about long and variable legs of monetary policy, first of all, to just level set for our audience, what they typically have in mind is that from the time interest rates start increasing till the time you start seeing kind of the maximum impact that those increases have on unemployment or economic activity, say slowing that down a bit, or on prices, tamping down on inflation, is somewhere in the order, typically if you look at like historical estimates and statistical ways of looking at this, of maybe 4 to 6 quarters, maybe for activity, 6 to 8 quarters longer for inflation. Now, that was a very astute question that was asked. Those historic relationships between variables, those were estimated over time periods when the central bank, when the Federal Reserve and other central banks around the world were not very transparent about what they expected to do with monetary policy. Some of you may know, up until it's a very recent, the summary of economic projections we're talking about is a kind of a recent development in the past 10, 12 years that the Federal Reserve's been doing that. Even if you go back to the 80s or 90s, there was almost no explanation whatsoever given, even about what the policy action was. The Federal Reserve made some policy action, and then interest rates changed or the money supply changed, and then markets figured it out. So given that we're communicating, we're more transparent about the policy we have, and we're communicating in advance now, that's going to lead to market interest rates actually moving quicker than they did, say, 30 years ago. So then there's an open question. That would be a reason that you'd think that that the effect of monetary policy on the economy will speed up, right? That we're communicating where we're going in advance. So that way, even back in October, November, December of 2021, markets were starting to say, oh, a tightening's coming, higher interest rates are coming, even though they hadn't begun yet. Maybe back in the 70s, these longer term rates didn't move up ahead of short term rates. So that would be a factor leading there to be a shorter leg in monetary policy on the economy. The question is how much? So yes, financial markets might move sooner, but still there could be a delay from when financial markets move, longer term interest rates, to when that starts to affect the economy. So something that we see in the data is that the more interest sensitive sectors of the economy, think the housing sector, think the manufacturing sector, they have been the sectors of the economy that throughout 2022 that first reacted. So much higher mortgage rates, guess what? Housing sector slowed down in 2022. But other sectors of the economy that produce services and so on haven't slowed down as much, or started slowing down to the extent that they have much later. And so there's still going to be some lag to monetary policy. It may not be as long, but trying to understand exactly how long that will be, I think, is an active area of research.
And building on that just a bit, Ben, there's another questioner saying, there is so much more information available now than there used to be, and it decays fairly rapidly. There is new communication, the media, the internet, there's expanded regulatory reporting. Has there been thought to increasing the frequency of the SEP based on all of that?
Yeah, that's a good question. So there's I think there's so let me go back to think about FOMC communication overall, right? On the one hand, the FOMC has made a concerted effort in the last, again, I would say 15 years to increase transparency, to talk more to the public, to be clearer about what we're doing. On the other hand, there are a number of participants on the FOMC. It's a committee. Yes, Chair Powell is the chair of that, and I think that markets listen very keenly to what he's saying. But there are other participants who are also talking, and there's different views. And so there's a question about how much communication, what amount of extra communication leads to more transparency, more effective policy. What amount of more communication could be distracting. And I'll get in my next two slides to a little bit some other features of the SEP where this is, I think there's a question about how do we use the SEP, which is not, by the way, a consensus opinion of the committee. It's not something that everyone on the committee comes to and they agree upon and they put out a number. As I've been describing this, it's what I've been showing so far has been a median of the committee. So we'll see in a bit, there can be some disagreement across the committee on what they think is appropriate. And so I've been reporting the middle of the committee. So there's a question about whether, does showing this every 6 weeks, does that actually provide better information? In some sense it might, it's more up to date, it's not stale. On the other hand, maybe it's not the best way to do that. Now there are, speeches by committee members. There's the chair's press conference every 6 weeks that are providing that more up-to-date information on how we're responding to economic developments. But that's one of the trade-offs. Let me also say that I think the question was, has this been considered? I think we're always thinking about, are there better ways to communicate? And are there ways to change it? But to my knowledge, we have not actively considered in the last, say, year, changing to a higher frequency of the summary of economic projections.
And if I just throw in one more question, Ben, and then we'll let you move on, but you did throw out that word transitory from earlier in this slide. And a questioner is wondering, has the Fed changed its approach to communicating because of that experience with the word transitory and realizing later that it wasn't, in fact, transitory?
Yeah, I mean, I think that there's actually still a debate a little bit about the transitory nature of inflation. There would be, I think that the Fed certainly has moved away from that word because we would say the inflation has been more persistent than we thought in 2021. But you'll see public commentators right now saying, oh, the fact that inflation is coming down as of now shows it was transitory. The transitory time it took to bring down was longer than we thought, but was still transitory. So yes, I think that I would say we certainly, with the ongoing the features of the pandemic, with the war in the Ukraine. Obviously, the war in Ukraine, that's kind of like an extra feature, right? You might not say that was just more persistent inflation. That was like a new shock that pushed inflation up yet again. But the Fed, I think, has, if you look at speeches of policymakers and so on over the past year, have certainly moved away and are not describing that way. We're still thinking, obviously, the Federal Reserve, that policy definitely has to get inflation down to 2% and has work to do. All right, well, I will move on from there. Thank you for those questions. I'm happy to take more. But the point of this slide, again, really in this gold area, was that because of the Fed's forward guidance, moving from a path that was down, was lower to the gold path, was able to move up long-term rates even before short-term rates. Let me mention two final bits of information that the SEP provides. One is that FOMC, it provides an assessment of the long run effects of developments. So we just heard a question about transitory. You can think about very, very persistent effects, like what's the effect of economic developments on how we expect the economy is going to behave 5 years from now, 10 years from now, okay? And this is, again, I'm showing for the variables now. Core inflation, we don't have a long run projection for, we just have one for PCE inflation, so I've dropped that from the table. But this is showing the median longer run values for our four variables as of different times, as of September 21, when that SEP was made, till the most recent one, March 2023. This is a pretty boring table, right? If you look across the rows, these numbers don't change. Now, barely, okay? And so what this is showing is, even though we've had some shocks that have hit the economy over the course of the past few years, and inflation went up, and our understanding of how much we'd have to raise the interest rate went up. If you look at the expectations for growth in the long run, what's potential growth? It stayed around 2%, a little below. Potential, what do we think the natural rate of unemployment is? Well, still around 4%. What's our goal for inflation? What do we aim to get back to? Still 2%. And our expectation of what a neutral federal funds rate would be in the longer term, still unchanged at 2.5%. Now you may say, Ben, do these longer run changes, do these longer run expectation of what happens in the long run, what happens in some sort of steady state of the world, do they ever change? Yes, they do. So let's look back to middle of last decade, from 2014 to 2017. For those of you who carefully watch monetary policy or think back about what was happening in the economy at that point, you may remember that in 2014 to 2015, the Federal Reserve was talking about raising interest rates for the first time since the global financial crisis, since we cut rates to essentially zero in late 2008. Okay, and there was some talk in late 2014 that there might be a rate increase or two in 2015. There wasn't an increase until the very end of the year, and then there was kind of an expectation at that time that maybe we'd have, 3 or 4 more increases in 2016, but we didn't. We only had one increase again at the very end of the year. So there was a very slow, gradual path of rate increases. Why did that occur? Well, it occurred because the economy, even with low rates, was slow to heal, right? The economic activity was picking up, but the unemployment rate was staying around 5%, and inflation was not picking up and going above 2% target. It was actually staying below the target. And so if you look over these years, so this is the SEP as of the end of 2014, 2015, 2016, 2017, what you'll see is a gradual reconsideration, I think, by policymakers of, well, what's the underlying growth of the economy? We actually think from the end of 2014 to 2017, they reassessed, the median of the committee reassessed that inflation, or that GDP growth would be about 0.5 percentage point slower, that the unemployment rate could actually be lower without causing inflation. So about 0.75 percentage point lower. There was no change in the FOMC's inflation target. They still thought we can get back to 2%. That's our target. But there was a big drop in the federal funds rate from 3.8% to 2.8%. And so that's really an assessment, right? With slower economic growth, with inflation actually coming in below target, there was an assessment that we are now in a world where we can have lower interest rates, and those interest rates won't be excessively stimulative. And that was an assessment that took place over many years. So I would think that as being the types of shocks that we were receiving, not just during these years, but also earlier in the decade, stemming from 2008, had changed the economy in some more fundamental way that would lead to lower required interest rates on a kind of an average basis. And so that experience shows just how, you can read that from the SEP, the types of shocks we had then, explaining why we kept interest rates low from 2014 to 2017, was more about a reassessment of more permanent changes to the economy than what's going on right now, which is little reassessment of permanent changes, but a response to shocks that have happened that require much higher interest rates.
And Ben, can you just define what you mean when you say longer run? What is the longer run?
Yeah, in the way conceptually we think about it is the longer run is the state of the world once all shocks that are currently hitting the economy have died out, and we're kind of back to a more normal type of steady economy. Now, this is actually a question in the SEP. Again, I'm only showing you a small part of the output of the SEP, one table or some aspects of one table for the median. There are, if you look in June, in 3 weeks, there's actually a 17-page document that will be released at the end of the meeting. It has a bunch of figures and tables showing more data. And then with a 5-year delay, there's actually, a 40 to 50-page document that's released, which shows not just summary of the projection, but it shows every individual policymaker's projection, and it also includes a bunch of narrative descriptions of how policymakers, not just the numbers they put down, but they are asked, what are the key factors affecting your forecast? What's your judgment? How has your judgment changed since last SEP? These types of things. And one of the questions they ask is, what is your assessment of how long it will take us to get to the longer run? And they're kind of asked, the longer run is typically, so I would think about it as being 5 to 6 years in that range. But then policymakers can, provide explanation. If they're thinking about the longer run as being an even longer period of time or a shorter period of time, they can provide that information in the narrative questions, and you'll see it there. Okay. Finally, one thing that the SEP provides is it provides a range of views among FOMC participants. So this is not an agreed upon, a consensus forecast for the economy. Each member puts out their own projection, and then I've been showing you, the median of those projections. But you do see some data in what's released of policymakers having different views. And so let me show you one plot that gets at that. This is what's referred to as the quote unquote dot plot. Sometimes you'll see that in newspaper accounts or so on. And this comes from the March SEP. What this shows is what policymakers' assessment of appropriate monetary policy or the appropriate federal funds rate is at the end of each year that's in the projection. So 2023, 2024, and 2025, and then also in this longer run we just discussed. Each dot here, and there are 18 of them, because remember in March, Vice Chair Lael Brainerd had resigned and left for a post in the administration. So we still have that open position at the board, but there are 18 dots here. Each one of these dots represents one policymaker and their entry for the appropriate federal funds rate, say in this first column at the end of this year. And so what do you see? The median, right, and also the mode in this case of the most policymakers had a expectation that 5.1% would be the appropriate rate at the end of this year. Now, there were 7 policymakers who were distributed above that level. There was 1 who was below. And I think what you want to think about this is policymakers, right, have different, we all, and economists more generally, or people who work in the Federal Reserve, you all out there, we have access, right, are looking at similar data, and the policymakers have similar objectives, but they may have a different understandings of what aspects of the data are most important for reaching our goals as the Federal Reserve, so maximum employment and price stability. And so they're going to have different models of how they think the world works, and what amount of what rate of monetary policy, what rate of the federal funds rate is going to be necessary to best achieve our objectives. And so here you see, right, some disagreement even for the end of this year's, ranging from, we'll be done raising rates, we'll have a rate of around, slightly under 5%, to we'll need to go almost as high as 6%. Going forward into 2024, there's more dispersion of these rates. So you see the median of the committee is moving down here. It's around 4.3%, but there's a range of views. Some, I would imagine, think inflation is going to be dropping off quite strongly. So they think or the economy is going to be weakening considerably. And so there's the ability to lower rates quite a bit. Others, might think inflation is going to be more persistent than their colleagues, or they think that it's going to take higher rates to make sure inflation comes down. And so I think what you're seeing here is different assessments of what policy will be appropriate to achieve our objectives. And you see that in 2025 and again, the longer run. And so I think this is useful for people to see that there is some diversity of opinion on the FOMC. And this is actually, when just one more note on the SEP, operationally, what happens is each participant is asked to provide their forecast, and they make that forecast before the FOMC meeting actually occurs. Okay, so it's an input into the policymaking process. Now, as they hear from their colleagues, as they have debate around the table in Washington that takes place over the course of 2 days, they have the opportunity to adjust their forecast, and they can do that. But this does give some sense of, going to the meeting, they can use this in some ways to communicate to each other, to have a common framework for thinking about what's going to happen in the economy, how does policy feed in that, what things they should take into consideration. So let me finish with a slide on takeaways. I hope today, you learn the SEP, the Summary of Economic Projections, is a communication tool that the FOMC uses. It can provide information about how the economy has evolved. So think about the slide showing from September 21 to March 2023, what data, what were some of the events that happened, how that affected our outlook for economic activity, inflation, the labor market, and then how policy changed as well, or expectations of policy changed. It gives us some information about the appropriate stance of policy. Okay, again, think about this plot, which is showing for each policymaker what their appropriate stance of policy, what they think it might be. So we get some information about both where the center of the committee is, but also dispersion around that center. It's a powerful tool to provide forward guidance, to influence financial market conditions, to manage expectations. And so we saw some of that, right, with the behavior, what happened from fall of 2021 into spring of 2022, that even though the Federal Reserve had not raised rates, longer term rates started moving up in advance. And I would finally say, the SEP is not a commitment to a specific policy rate path. It's not the committee having agreed upon some median. It's reflecting individual views. It's aggregating that information. It's out there. And as probably you're all aware, we saw, kind of repeatedly in some of those time series charts, there was a median path expected, but the actual path we ended up raising rates more quickly than had been expected at various times. So it's something that it changes with the data that we get in, and policymakers are doing their best to respond to incoming information when they make their projections. So let me stop there. I'm happy to take any questions.
If you do have questions for Ben, please type them in the chat box. And Ben, I want to go back to that discussion about the longer run. You had mentioned the longer run was about economic normalcy. And there is a questioner asking, are there certain perspectives in the SEP that consider the longer run without the assumption of economic normalcy at the longer run?
Yeah, I mean, I guess when I say normalcy, I would say whatever you think things will settle down to. So if there is a perspective that says, hey, we're never going to settle down again, or it's going to be a very abnormal world. Now, there's two approaches. one, their numbers could reflect that the world has permanently changed in some way, and we'll do that. There's actually also, there have been policymakers over time. Jim Bullard this is the president of the St. Louis Fed, for example, has indicated that in certain times that he could see, two different, a world in which two different results could happen. And so he said, I'm not going to make a longer run projection, other than saying, I think we're going to do what it takes to get inflation back to 2%. So he makes an inflation projection, but hasn't made projections for other things. So there's scope for doing that. President Bullard was a little unorthodox in that approach, but that is something that has been done.
Thank you. And there is also a questioner wondering, we discussed a little bit, perhaps polling the SEP more frequently. There's a questioner wondering, is this a burdensome exercise? What is the amount of resources that go into producing this document?
Yeah, well, that can be, I think one of the reasons that we do it on a quarterly basis. But I think from my perspective, being here an advisor to President Kashkari at the regional level, this type of exercise is part of the thing that we're doing all the time, regardless of whether we make it available to the public. So it's a useful disciplining device. It's a useful way of thinking about and the data and what is appropriate monetary policy, because policy should be forward looking and thinking how the actions we take are going to affect the economy in the future. So I think it's something that policymakers and their staffs throughout the system are doing regularly. I do think, yes, there is a any process of coordinating of the staff at the Board of Governors in DC and the FOMC Secretariat's office and pulling together that information of releasing the report. Some of those things are standardized, but it is an additional task, and so that can be a cost that weighs into what is the optimal time that we should have between why don't we do this every day and just send it out to the public each day versus just when we meet. That certainly can play a role.
Mm-hmm. And for our questioners who were asking, when does the FOMC meet? How do we get access to those documents? I've placed a link in the chat to the Federal Reserve's Board of Governors, where the dates are listed, as well as the documents that Ben is referring to. We've also got a question about the 2% inflation target, and if part of the reason for adopting that was about communicating with the larger public.
Yeah, I think it absolutely was being more transparent about what we were doing, being explicit about what our objectives are. I think the academic literature has shown that helps to anchor inflation expectations. And so, if you look back at transcripts from FOMC meetings, I think the first time you start seeing discussion of quantitatively what should our inflation target be was in the mid to late 90s, when eventual Chair Yellen was a vice chair of the Board of Governors at that time, and there was some discussion of should that be 2%. So in some ways, the Federal Reserve, the FOMC, was acting in that ways implicitly, maybe, but in 2012 they made that explicit, and that was, I think, a useful thing to do.
Thank you. Going all the way back to the first part of your presentation, when you talked about what types of things we might see reflected in the SEP, you talked about the war in Europe, you talked about lingering effects of COVID and supply chain. There's a questioner asking to what extent climate change appears there, and in particular, monetary damages from things like natural disasters. Yeah,
I mean, any of those factors that, if to the extent that they are influencing the economy in the short run, can show up there. So in the narrative discussion that policymakers would have, they can reference any developments in the economy that affect what they think is happening with economic activity, the labor market, inflation, and so on. So, I mean, especially think, we didn't do the SEP during Hurricane Katrina, but think about that, or Superstorm Sandy, that had an impact on a large part of the economy or important sectors of the economy that then fed through to others. you could see some impact there about, hey, we have this specific event. Let's say it happens in, September of the year, or, later in the year, but early enough, not too late November, but, early enough that it could have some effect. Short-term disruptions have some effect on numbers through the end of the year on what monetary policy should do. Those types of things, the questions they're asked, for the narrative questions, are very open-ended. And so if policymakers think that that's an important consideration, they can mention that.
We've also got a questioner asking about the stagflation that some analysts predicted last year, and whether you have seen any evidence of that, or a belief that the markets are thinking that's going to happen.
Yeah, so stagflation, for those who don't know, refers to a situation with high unemployment, very weak economic growth, but high inflation. And so something we experienced in the late 70s. If you look at markets' expectations for inflation rates, so these are from financial markets, they're very anchored after, if you look a year to two out, definitely from longer than that, right around 2%. So they see inflation coming back. If you look at surveys of inflation, again, the shorter term measures in the next year, inflation is up, but then coming down. I think in terms of economic growth, that it could be slower. Part of that is, our country, in terms of its population, is not growing as fast as it was. So GDP itself may have a slower growth. GDP per capita, maybe a little, or GDP per worker, maybe a little less so than before. But I would say, when I think about stagflation, I think about that as being kind of a longer run, a medium term type of dynamic. And I would say what we see from the SEP is most policymakers, haven't seen their longer run assessment of the economy change. And so I think markets and surveys of professional forecasters would be consistent with that outlook as well.
And one last question for today. Does the Fed take into account demographic projections and the implications on the workforce?
Yes, absolutely. That is something that affects, labor supply in general. And so, one of the things, another type of shock, maybe, or an effect that came out of the pandemic, reduction in immigration for a while. Labor supply, actually, yes, there was a lot of labor demand, a lot of job openings, a lot of people, firms looking to hire people, but labor supply, there's been a big change. Immigration is one. Retirees, we're getting to the point where the baby boom generation is retiring in greater numbers. And so labor supply, part of there was more labor demand than labor supply. Part of that was higher labor demand because there was a lot of spending going on, but also part of it was there was lower labor supply because of concerns about health, because of retirees, because of fewer immigrants for a couple of years, that now has actually picked up quite a bit. And now maybe a force boosting labor supply, catching up with labor demand. So yes, we have to take into consideration those things when we think about numbers of employment growth and so on. We have to take that, how is employment growth relative to kind of some standard baseline. That standard baseline should factor in demographic changes.
Great. Thank you so much, Ben. And thank you to all of you for joining us today. We will be sending an email next week that contains a link to this video, as well as a copy of Ben's slides. And we would appreciate it if you would stay on long enough to answer the 3-question survey that will pop up in your Zoom window after this webinar ends. Thanks so much, everyone. Have a great day.
Thank you.